JPMorgan Chase CEO Jamie Dimon is slamming central banks today at an event in Saudi Arabia. He warned of the dangers of making forecasts on the economy, saying the Fed was, quote, 100% dead wrong 18 months ago. This comes as the next Fed decision is just over a week away now. Joining us is Tim Urbanowicz, that's head of research investment strategy at Innovator Capital Management. So Tim, thank you so much for joining us.
Good to be with you, Josh.
So let me start with Mr. Dimon's comments, because one thing that I thought was interesting at this speech, Tim, is he seemed to just dismiss the impact of more rate hikes. Tim, at this conference, he said, I don't think it makes a piece of difference whether rates go up 25 basis points or more. When you heard that, Tim, do you agree with Jamie Dimon there?
Yeah, I think he's spot on. And really what we've been saying for a long time now is less important than another 50 or 25 basis point hikes is really how long interest rates are going to need to stay at these restrictive levels. Because the reality of it is the longer that we stay where we're at right now, the more damage that we're going to see play out in the economy. We have to remember that interest rates hikes, their impact is lagged on the economy. And right now we're kind of in that waiting ground where we really start to assess, okay, what type of damage has already been dealt. And I think there's a very strong case right now that interest rates are restrictive. And even if you look at just the backup that we've seen in longer dated yields, we have the 10-year keeps flirting with 5%. You'd have mortgage rates that are right around 8%. That's certainly going to really hamstring home buyers and consumers alike. So really now we're at this point where we need to wait and see what the damage looks like with those hikes. But I think he's exactly right in that, it's really about how long rates stay at this level.
Do you think that, however long rates stay at this level, do you think that in the bond market and the Treasury market, that yields have sort of topped out as around 5% the ceiling, do you think?
Well, I think it really depends on what the Fed does. If you look at some of our research that we put out recently on this, we tend to see that longer term rates like the 10-year Treasury typically peak within a month or so when the Fed finishes that hiking cycle. So we think there's a very strong case to be made that you either saw the last hike or you're going to see the last hike here this month. So we would anticipate that we're kind of coming to the end of longer term interest rates moving higher. With that, I will say that I think the situation in Israel right now does put a little bit of a caveat to that. If we see that situation spread out, you start to see other countries get involved like Iran, where you start to see a big impact on energy prices, oil prices moving higher. The reality of it is that's inflationary in nature. And if we see that, that might really limit what the Fed can do and even may force them to take rates even higher to combat any of those forces. It's a situation that we saw back in 1973 and 1990. In 1973, in particular, when you saw that situation playing out, you had the Fed that actually had to hike in the middle of a recession. So we don't want to see a situation like that play out, and that certainly remains a threat to that view.
And Tim, I want to switch gears a bit. We got big tech earnings after the bell, Microsoft, Alphabet. I was talking to Julie, Tim. We've had guests come on, at least more bullish ones, and they were really pinning their hopes on this earnings season. They really thought, listen, this could be a catalyst to move this market higher. What are you expecting to hear from big tech, Tim?
Well, I think the entire index is counting on these names to really lift us out of this earnings recession that we've been in. There's a lot of good news priced in, so we need to see these companies deliver. But at the end of the day, I think we need to back up and remember that right now we're really in a macro-driven market where a lot of the news that you're going to see coming out is going to take a backseat to a lot of the economic data, inflation data, the data coming out of the labor market, because the reality of it is what we have seen historically is that interest rate hikes impact earnings with about a 2-year lag, which means we're really starting to get into that cycle now where you start to see that impact. And one of the things that we have looked at is really when do earnings bottom? And very consistently, one thing that we have noticed is that earnings never have bottomed before the Fed finishes its hike cycle. In fact, they typically bottom out anywhere from 13 to 38 months after the Fed is done. So regardless of what we see right now, again, we're in a macro-driven market, and it's really about what's going to be coming through the pipeline next year.
So you don't think then, Tim, that tech earnings are going to sort of dominate here and help pull the market up? And by the way, for all the talk of high yields being problematic for big tech, most of these stocks have done well this year.
Yeah, they've done very well. They have very strong cash flows, which is very encouraging overall. But again, reality is it's going to be more about guidance than it is results. So that's what we need to focus on. And again, if we see the impact that we've seen historically, we don't know what that looks like yet. So we're coming to the point where that's going to be the case here very soon.
And Tim, we've hit a lot of topics today, but I want to end here with more headlines from Congress. They keep coming. Now we learned that Republicans narrowly chose House Majority Whip Tom Emmer as their nominee for Speaker. How worried, if at all, Tim, do you think investors need to be about this continuing drama in Washington, especially as we get closer and closer to this potential government shutdown?
Yeah, I think it's an issue we've been really looking at all year, and really a big question comes down to where are interest rates going to. I think if you looked at the debt ceiling scare earlier in the year, there was a lot of question marks of, is the debt still reliable? Is it still creditworthy? Is that still the same? And seeing these continued issues is certainly concerning. What's also concerning, however, is if you look at the imbalance in the budget that we've seen. We just wrapped up the fiscal year with about a $1.7 trillion deficit. That's very, very significant. There's a lot of bonds that need to be issued, to meet those spending needs. And this is coming at a time where the Fed is stepping back. We have foreign investors that are stepping back. So in addition to the Fed holding rates higher for longer, in our view, a lot of this drama really points to really a floor under interest rates as well, as that supply and demand is a little bit out of balance.
Tim Urbanowicz, thank you so much for joining us. Really appreciate it.
Great to be with you.